There is a pay rise sitting inside your salary right now, and it is the tax office offering it, not your employer, the government. It works like this. One slice of your pay can be taxed at just 15 cents in the dollar instead of the rate you pay on everything else. For a lot of working Australians, that ordinary rate is high. This one is low. Same dollar, a fraction of the tax, and the difference is yours to keep. And yet, most people walk straight past it every single year. There is one catch buried at the top end. For some high earners, the tax office quietly takes back half of that discount, and the people it happens to almost never see it coming. By the end of this, you will see the whole move and exactly where that catch bites. One line before we open the plans. This is general information, not personal advice. This is how the system works, not a set of instructions for you. Your situation is your own, so get advice before you act. Now, the pay rise has a name, salary sacrifice into super, and the reason most people leave it on the table is simple. It is invisible. Nothing lands in your bank account, so it never feels like a win. By the end of this, you will understand exactly how $1 of your salary can be taxed at 15 cents instead of your full rate. You will see the ceiling on it and a little known way to carry unused room forward from past years. You will see who this genuinely suits and who it can quietly hurt. And you will see the catch at the very top that halves the whole benefit for the people most tempted by it. Start with what actually happens. Your salary normally travels one road. It leaves your employer, it passes through the tax gate at your own rate, and whatever survives lands in your account as take-home pay. Salary sacrifice builds a second road. You ask your employer to send part of your pay before it is taxed straight into your super fund instead. It never touches your normal tax gate. Inside super, it passes through a different gate, a flat 15 cents in the dollar. That is the entire trick. You are not earning more. You are redirecting money you already earn, so it flows through the low gate instead of the high one. And the wider the gap between your normal rate and that 15%, the bigger the win. Picture it with a single dollar. Say you are a solid earner, taxed well up the scale. Left as ordinary salary, a big slice of that dollar goes to tax, and the smaller piece lands in your pocket. Now, sacrifice the same dollar into super. It is taxed at 15 cents. 85 cents lands in your super, working for you. The dollar that would have been chipped down on the way to your bank account arrives in your super almost whole. Multiply that by a few $1,000s a year for years, and the gap is not small. That is the pay rise. Nobody sends you a pay slip for it, which is exactly why it is so easy to ignore. Now the ceiling. You cannot pour unlimited money through that 15% gate. Each year there is a cap on how much can go in at the concessional rate. Cross it, and the extra is taxed back at your normal rate, so the benefit vanishes on that slice. Two things people miss about the cap. First, it is not empty when you start. Your employer's compulsory super is already filling part of it. So the room left for you to sacrifice is the cap minus what they are putting in. Second, the cap counts everything at that rate together. Your employer's contributions and your own sacrifice dollars share the one ceiling. So the first job is always the same. Work out how much room is actually left before you fill it. Here is the part almost nobody uses, and it is the most powerful lever in the whole video. If you did not use your full cap in recent years, that unused room does not just disappear. You can carry it forward. As long as your total super balance is under a set threshold, you are allowed to stack several years of unused cap and use it all in one later year. This is the tool for the big year, the year you sell something or get a bonus, or your income spikes. Instead of 1 year's worth of the low gate, you can push several years of unused room through it at once. There is a clock on it though. The oldest unused year drops off after 5 years. Use it or lose it. Before anyone rushes at the low gate, the honest catches, and this is where the beginner videos go quiet. First catch, this money is locked. Once a dollar goes into super, you generally cannot touch it until you reach what is called preservation age and actually retire, or until super simply opens up with age. For most people, that is years, often decades away. That is the real trade. You are swapping access now for a lower tax rate later, which means salary sacrifice suits money you genuinely will not need before then. If there is any chance you will need that cash for a home deposit, a business, an emergency, then locking it inside super is the wrong door. The tax saving is real, but a locked dollar you needed is worth less than a taxed dollar you could reach. Second catch, the size of the win depends entirely on you. Remember, the whole benefit is the gap between your normal rate and 15%. For a high earner, that gap is wide and the win is large. But for someone on a low income whose normal rate is already close to 15%, the gap is thin and sometimes there is barely a benefit at all. Salary sacrifice is not a universal good. It is a lever that pays in proportion to your tax rate. The higher up the scale you sit, the more it does for you, which sets up the strangest part of the whole system, right at the very top. Because at the very top, the government does something that feels contradictory. It waves you into super with the low 15% rate, and then, once your income crosses a high line it has drawn, it charges you extra on the very contributions it encouraged. This is the catch from the start of the video. Cross that income line and an additional layer applies to the money you put in at the concessional rate. In plain terms, the 15-cent gate becomes a 30-cent gate for those high earners. Now, 30 cents is still below the top of the scale, so the move is still worth doing, but it is worth exactly half of what the headline promised. And the people who hit this line are the same people most drawn to salary sacrifice in the first place, high earners chasing the biggest tax saving. They budget for the 15% version and quietly get the 30% one. So read it honestly. This is not a trap, and it is not the tax office taking the benefit away. It is the system deciding the discount should be smaller for the very highest earners and larger for everyone below them. If you are one of those high earners, the answer is not to walk away. It is to size the benefit at the real rate, not the advertised one. 30 cents in the dollar, not 15. Still a saving, just not the one on the poster. Knowing which version applies to you is the difference between a plan that works and a pleasant surprise that never arrives. So now you can read the whole move. Salary sacrifice redirects part of your pre-tax pay before your normal tax gate into super, where it is taxed at the low concessional rate instead. You do it up to the cap, minus whatever your employer is already putting in. If you have unused room from past years and your balance is low enough, you can carry it forward and push a big slice through in 1 year, as long as you beat the 5-year clock. You accept that the money is locked until retirement, so you only sacrifice what you will not need before then. And if you are a very high earner, you size the win at the real rate after the top end catch, not the headline. That is the pay rise the tax office offers, drawn as a blueprint. The only reason most people never claim it is that it never shows up in their bank account. If this made the low gate finally make sense, there is a rule that does something similar for your home. You can move out, rent it to someone else, and in the right conditions, still keep it completely free of capital gains tax for years. That is the next video. Subscribe if you want it the moment it lands. I will see you there.